So we move into a new tax, chargeable gains, in effect shortened to CGT, capital gains tax. In this particular sort of opening chapter, we'll just deal with the basic principles. And indeed, for me, CGT is one of the easier taxes to deal with because, in essence, CGT is based on a three-liner: proceeds less cost equals gains. In other words, it's all about selling chargeable assets, making gains or losses, and building them into a CGT comp. Let's take a deeper dive here. Let's talk about terminology first. What do we mean? Well, we mean that CGT for personal taxpayers apply to gains, less losses, arising from chargeable disposals of chargeable assets made by a chargeable person. And let's just stop there for a second. Three areas. We need to have a chargeable disposal, we need to have a chargeable asset, and a chargeable person. So let's watch down below as we develop this particular part one, as it were, basic principles, where perhaps some assets aren't chargeable, they're exempt, or maybe there hasn't been a chargeable disposal, etc. Okay? Note that in terms of chargeable gains for companies, not individuals, they're liable to corporation tax based on the CT comp. More of that later in the syllabus. Okay? So there's the essence of it. We have a new tax relevant to personal taxpayers, basically surrounding the idea that you have a chargeable asset, you sell it, you make a gain or a loss, and you build that into a comp. Okay? Now, in terms of chargeable disposals, assets, and persons, first off, let's be clear on what we mean by a chargeable disposal. Note that, as mentioned up top, it could be the sale, but it might be the gift. So, for example, if I give you a house, that's a disposal. Just because you haven't paid anything for it doesn't mean it's not a disposal for CGT purposes. Or maybe I give you part of it. In effect, the sale or gift or all of part of a chargeable asset could be subject to CGT. In addition to that, where we have the loss or destruction of a non-wasting asset, don't worry about the definitions right just now, that's also a disposal. In addition to that, if we get a capital sum, let's say insurance compensation because an asset that was chargeable has been destroyed, that's also a disposal. So disposals rest on the idea that really it's not just a sale for cash, for proceeds. There's several ways in which a disposal could occur. What about the date of the disposal? You know, generally speaking, it will be when the asset is sold. So I sold asset A on the 5th of March. That's the date of disposal. But let's be careful here. Note that where a contract is signed, where the asset transfer requires a contract, if the contract is conditional, it's when the condition is satisfied. Okay? Or perhaps when the loss or destruction, as mentioned above, occurs, or when a capital sum is received. Okay? So this area here, I would say, is slightly secondary to this one. Okay? The TX examiner wouldn't tend to target or mess around with the date. Generally speaking, he'll say something like, Mr. A disposed of an asset, sold or gifted the asset to Mr. B, etc. Okay? Now note that in relation to a chargeable asset is basically any asset that's not specifically exempt. We'll see exempt assets in a moment. Outside of that, chargeable persons, basically individuals and companies. Note that, for example, charities are not chargeable persons. They're exempt from CGT. So this little branch here, I guess, sort of concerns that three-pronged area. You know, disposal, person, and indeed asset. Okay? Moving from there, in terms of the computation, I mentioned from the off that broadly speaking, the CGT comp is straightforward. It's basically a three-liner. Let me explain what I actually mean by that. So if we look at the comp here, let me just get this into play, okay? So what we have here is, I guess, if you will, the first part of the computation, yeah? As we can see, headed up, computation of gain, chargeable, or allowable loss. So what's going on here? Well, pretty straightforward. What do we see first off? We see the sale consideration. In other words, the proceeds. What did you sell it for? Well, 100,000, okay? Let's take off the incidental costs of sale. So for example, perhaps some fees, agent fees or commissions, etc. That's the net consideration. Outside of that, what are the allowable costs outside of incidental costs of sale? Well, several possibilities. Obviously, the original acquisition cost and any incidental cost and purchase. I purchased it 10 years ago for 50,000 and I paid some legal expenses of a few thousand, okay? Outside of that, 2 and 3, yeah, enhancement. In other words, yeah, I bought the asset, but I also improved it. It was a house I extended by 25%. And indeed, outside of that, perhaps I had to go to court to defend title, okay? 3 less common than certainly 2, okay? So again, common sense, quite straightforward. I bought an asset, I improved it a little bit. Yeah, you can deduct that when you sell it. So what's the net off effect? Well, there's my chargeable gain or allowable loss. Now, when you look at this, I think that in essence, all that we're talking about, if you simplify it, is subtraction. Proceeds less costs. That's a cost, the incidental cost of sale. That's a cost, the acquisition cost. That's a cost, and that's a cost. It's just some items deducted from proceeds to get to this area. Now, we're not finished yet because, as mentioned, this is the first part of the chargeable gain comp, as it were, okay? Now, in terms of disposal proceeds, just a couple of things to run through, a couple of, if you will, tricks, yeah, that the examiner is going to play on us. You know, first things first, I mean, for sales made in the open market, disposal proceeds is the gross selling price, yeah? Now, certainly the gross selling price becomes cost for future disposal purchases for the purchaser. In other words, we have me and you. I sell it to you for 100,000. Let's say I make a gain, I pay my tax. For you, the cost is what you bought it for, obviously, okay? Now, in terms of incidental costs of disposal, I always try to think of the sort of F word, fees, yeah? We saw incidental costs of disposal up top, yeah? Incidental costs of sale, and indeed incidental costs of purchase. Basically, same thing. I always think of the F word, so I'm always looking for fees. Now, 99 times, I would say ballpark, out of 100, where you see some sort of fee, yeah, or cost associated with the disposal or the purchase, it's going to be deductible. In other words, you can include it within this little area and this part of the comp, okay? So that's the incidental costs of disposal, okay? Now, in terms of sort of moving from here, there's an area coming up where we need to establish the rate to apply to this amount, okay? Now, I wouldn't say it's overly complex, but students do tend to get sometimes confused with it. Now, I'll deal with the comp down here, but let me take you through the narrative, yeah? So really what I'm saying is, okay, so I understand the three-liner. I understand asset, person, and indeed disposal. So I've got to the point where I've got a gain. What do I do now? What is the rate to apply, yeah, to that gain? So let's think about it. The taxable amount of gains, yeah, is deemed to be added to the taxpayer's taxable income as if the gains were the top slice of the income, yeah? However, both comps remain separate. Now, there's a reason for this. Don't be alarmed, okay? Now, What we do in effect is look at the taxable gains, as we've just said, as the top slice. So if the taxable gains in effect fall within the basic rate band for income tax purposes, you'll remember 37700, yeah, then in this particular case, yeah, the rate of CGT is 10% or 18% of its residential property. Let's leave that residential property issue for the moment. I'm basically saying is, okay, so the individual has income. How much of the income has been taxable and used up this 37700? Well, you know, it's used up half of it because they're fairly low income. Well, then half of it is available for taxable gains at the lower rate of 10%. Okay? Now, if taxable gains exceed the basic rate band, the rate of CGT is 20%. Note 28 for residential companies. Let's leave that for the moment. Yeah. Additional rate income taxpayers will still pay 20% on their taxable amount of gains. So a lot of information here, I know. Let me simplify it. Let me break it down. There is a link between the rate of CGT that is used and income tax. Yeah, it's a little bit strange, isn't it? Yeah. In other words, when we're trying to calculate how much CGT is payable for Mr. A, we have to look at his income because we have to know how much of the basic rate band for income tax purposes the individual has used. As mentioned in my scenario, if he's used half, yeah, then half is available at the lower rate, assuming it's not a residential property. Yeah, the balance would be taxed at the higher rate, 20%. Okay? Now, again, as I've said elsewhere, once we get into the questions and you see it in front of you, it's going to be easier to deal with. So, let's look at, excuse me, the second part of the comp. In terms of, let's say, a typical scenario where someone's affairs are such that they've got several assets that they've disposed of, yeah? And indeed, some are gains, but some are losses, yeah? So what do? Well, with gains and losses for the individual for a given year, we just pool them. We just put them into a pot. Well, I've sold 5 assets this year, 2 were gains and 3 were losses. We'll just lump them all together. And let's just say that you end up with a net chargeable gain. In other words, the gains outweigh the losses that you made on the 3 assets. What do you then do? Well, you take off what we call the annual exempt amount, 6,000 in our case, leaving you with this amount. Then what do you do? Okay, well, do you have any losses brought forward from previous years? Well, yes, I sold several assets last year and I've got 10,000 in terms of capital losses brought forward. Well, then you can take them off too. And then you get to the taxable amount. So in essence, this second part of the comp really concerns a scenario where we need to deal with not just one asset, but several different assets. We pool gains and losses. We take off the annual exemption. We then, and only then, take off the losses brought forward, okay, in that order, okay? A lot to remember, I know, but it'll come, don't worry. Moving from there, in terms of residential property and indeed general loss relief, I mentioned up top, let's just leave residential property for the moment, but first off, let's just deal with loss reliefs, which is basically what we've just been through in terms of the pro forma up top. Current year losses, straightforward, yeah? We just set them off against gains. That's it, before the annual exemption, okay? Now, in terms of the annual exemption, note it's use it or lose it, yeah? So we must do it in this order, yeah? We must offset current year losses against current year gains as we saw here, yeah? And once we've done that, yeah, then we bring in the annual exemption before brought forward losses, okay? So that's how current year losses are dealt with. Now, what about brought forward losses? Again, we saw that on the pro forma up top, Okay? Now, note here, the annual exempt amount is set off after current year capital losses and before brought forward losses. As such, unrelieved losses brought forward are only set off to reduce net gains to nil. The remainder carry forward. So what does that mean? That's a big mouthful, isn't it? Really what it means, looking at the pro forma here, yeah, is that once we've dealt with current year gains above, taken off the earning exemption, we can utilize the losses brought forward in a flexible way. We can just get rid of all of the leftover gains and then carry forward the balance. So notice the slight difference between current year losses and brought forward losses. Okay? Now, residential property. Yeah. Note that in terms of capital gains tax due on a residential property, payments due within 60 days of disposal along with the return to HMRC. Now, the reason this is slotted in here is that's the only asset that has a specific, really timely rule in relation to payment. Yeah? This payment on account, because tax on all other, or CGT on all the other assets, is due 31st of January following the tax year. So for example, in relation to our year, which ends on the 5th of April 2024, the CGT on any assets sold realizing a gain where CGT is due 31st of January 2025. Okay? Hope that makes sense. Now, married couples. Under this CGT banner, married couples have an advantage. Yeah? They have an advantage. We know that they are, broadly speaking, within tax, married couples or spouses or civil partners, treated as separate. Yeah? But in terms of this area of married couples, there is, as I've just mentioned, inter-spouse exemption. In other words, there is, in effect, a no gain, no loss rule. So where married couples or indeed civil partners dispose of assets between themselves, no tax implications, no CGT implications. That's it. End of story. Okay? Moving from there, in terms of planning. So we've talked in this video so far about basics, haven't we? We've said, okay, so CGT is like subtraction, it's three-liner, proceeds less cost equals gain. Now, there's some monkey business in relation to losses, and there's also some fiddliness in relation to rates. Yeah, in some way, yeah, the rate of CGT to apply is linked into income tax. Yeah, and that basic rate band. Now, maybe that hasn't dropped yet for you, and maybe you're thinking, not sure about this, even if you've read the study hub, but don't worry, it will come. Now let's move on to just a little bit of planning, yeah, a little bit of basic planning for us. You know, three main considerations here. Let me just move this across and make it slightly more manageable. Bear with me 1 second. Make that a little bit smaller for us. Okay, so planning for CGT. Remember that, you know, if you, let's say in due course, maybe you work in tax, you know, the area of tax planning is aside from the area of compliance, isn't it? So compliance within tax is all about, you know, preparing tax returns, filing tax returns, paying tax. But planning, really, and indeed CGT planning, is about mitigating. It's about using your wits in order to reduce CGT liabilities, or indeed any other liability. So let's start with the obvious first, the annual exempt amount, okay? Note that if we're in a situation where, let's say, we have an annual exempt amount, as we know, yeah, you know, if it's already used by gains, so I've sold several assets the early part of the year, why not hang on and wait in terms of disposing of another asset, okay? If you don't have to sell it, maybe hang on because you know that you've got an annual exemption each year. And remember, with the annual exemption, it's use it or lose it. You can't carry it forward. So really, that's some simple planning. Watch when you dispose of assets. If you're already in a position where, let's say, I've disposed of two and the gains are 20,000, well, your annual exemption is used up. Yeah, why not delay for another year? In addition to that, you know, possibly consider bringing forward a disposal, yeah, if high gains are expected into a later year to ensure the annual exemption is utilized each year. So really, this first one is about timing. Yeah, it's about the timing of disposals. Okay. Now, what about the next area, the rate of tax on income? Now, if the level of other income, excuse me, differs between tax years, an individual should consider, if it's possible, to time disposal of assets to the years where income is lower. Yeah. Now, why? Well, remember, going back to what we said about application of the correct CGT rate. Maybe this year, yeah, I'm on a high income. Yeah. I've used up my basic rate band. I've had a great year. You know, I'm earning 150,000. Well, if I dispose of assets and have chargeable gains in this year, I'm paying 20% capital gains tax. But next year, I expect my income to fall dramatically, maybe to 10,000, 20,000. And on that basis, maybe I should delay the disposal of assets. Why? Because next year, if my basic rate band isn't used at all or not used in full, I would pay 10% on these gains relevant to these disposals. Okay? Make sense? Hope so. Next one, timing of disposals. I mean, several of them are sort of relating to timing in one sense, aren't they? You know, here we're talking about the delaying of the sale of an asset if it falls into the next tax year. We sort of talked about that up top, meaning that another AE would be available. Okay? In addition to that, obviously if you delay, then the date of CGT payable shifts, doesn't it? Yeah. So in effect, yeah, if we have an asset that we could delay disposal of, and indeed, let's say that it's in the FA23 year, we could delay the tax from the FA23 year if we don't dispose of it from 31st of January 2025 to 31st of January 2026, a full year. That's quite considerable. Okay. So the rest of this area here is just outlines or re-undermines what I've just said. Okay. So that's just a little bit of planning. Okay. Now, what about corporates, taxpayers? The right-hand side of this map, yeah, is all about individuals, and I hope it's made sense. Now, for corporate taxpayers, as I've said, companies, yeah, pay corporation tax on gains, not capital gains tax. Okay, so for chargeable gains for companies, bottom line is that it's certainly similar, but there are some difference. And the key point really for me is that it's subject to corporation tax. And the other key point, as you'll see when you go into the chapter, is that this area of indexation has an impact. In other words, companies have an additional allowance called the indexation allowance. Okay, I hope that makes sense, and that you enjoyed that particular video and our new tax. We've got several chapters to go. We'll build on what we've seen within this particular video. Thanks for listening.